The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Trump says he's de-escalating, and for now, the market takes him at his word. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Here's where we stand. The S&P 500, 1.7% higher. We were above 2% gains on the day at one point, but you can see fading just a little bit. I threw up the small caps because that's where you're seeing the biggest reaction in the equity landscape to that relief that we're seeing percolate through markets. The Russell 2000 higher by about 3%. It certainly helps that we are seeing a bond rally. Yields actually coming down for once. It feels like we haven't seen this for a while. The 10-year Treasury yield lower by nearly 5 basis points, so we are still above 430. And then Brent actually falling below $100 a barrel, down about 12% on the day. Romaine, of course, we're still a lot higher than we were about a month ago, but certainly a little bit of a relief here.
Yeah, definitely a lot of relief going on in markets right now. We should point out the equities had actually been under pressure coming into today. This is commodity trading advisors, those risk parity funds, and the vol targeting strategies had all cut exposure after the S&P broke that 200-day moving average last week. But that negative positioning, it was like a coil for today's rally amid hope that geopolitical tensions were easing, oil prices were falling, and maybe ceasefire talks were underway.
The market opened up, I guess, last night in Asia, with some anxiety that things in the Middle East looked like they were going to escalate. The president came out with a message saying, no, we're going to remove this deadline that he imposed or announced over the weekend, and the market traded off. The fundamentals are very tight out there.
The CEO of Chevron, they are speaking at the annual CERAWeek gathering of oil and gas executives. U.S. Energy Secretary Chris Wright also there, saying oil prices, they've actually haven't risen high enough to drive that demand destruction that markets had priced in, and nations are using their strategic reserves to ease prices. But the head of Abu Dhabi's National Oil, who had to zoom in for his presentation because of the war, he told attendees opening up the Strait of Hormuz is still the only solution out of the current energy crisis. For now, the tinge of optimism in equity markets is holding, and that's spread to other assets as well. Credit spreads narrowing, treasuries rallying, and traders emerging from the safe haven of the U.S. dollar. But while prices shift and sentiment moderates, the volatility across asset-wise still remains at a months-long high.
Absolutely. Well, I wanted to highlight bond volatility in particular because it feels like the Treasury market has been a little bit of a basket case over the past 4 weeks or so. And you can see that when we measure it by the MOVE index, which again just measures Treasury volatility. And you're looking at the biggest one-day net change going back quite a while towards the end of last week. And then take a look at how this white line has climbed. We have about a 4-year duration up on the board here. And you can see that actually we bottomed out in January of this year when it comes to volatility. And since then, the move has just been straight higher. So again, Romaine, we're seeing a little bit of a relief rally today. That's true across asset classes, but we know we're coming off of some pretty depressed levels when it comes to prices, at least. And the volatility has just been breathtaking.
Let's kick things off to the close with Kara Murphy, CIO at Kestra Investment Management. And Kara, maybe you could kind of help cut through some of the noise that we've been seeing. Obviously, we know that this market has been driven by the spike in oil prices and maybe potentially a drop in oil prices that we're starting to see here. How are you looking at the current situation and folding that into your long-term strategy?
So I think it's really surprising. If you're following the headlines every day, you're seeing this back and forth and continued conflict. But at the same time, when you look at what the indexes have done over the last couple of weeks, over the last couple of months, the market really hasn't reacted all that much. And this is not to say that the conflict is not important. It is very important for the long-term trajectory of the U.S. and global economy. But I think what it's doing is that it's obscuring what is a more important shift in market leadership that actually started way back in the end of last year. And that is outside of these, AI-driven Mag 7 names into other parts of the economy and the market. And so, yes, the market will to and fro on a daily basis because of these headlines. But what investors really need to focus on are these longer-term trends that will persist long after this conflict has hopefully ended.
Well, when we talk about those longer-term trends, and more importantly, that rotation, part of that rotation seemed to be dependent on the idea of a stable economy. And I don't want to make too much light out of what's happened in the Middle East, because you are right. the impact so far, certainly on the economy and to a certain extent the markets, has been relatively muted. But if we are in a potential situation where we do see a resurgence in inflation and, more importantly, elevated inflation that stays there, does that not undercut that thesis?
It does, and we've already started to see that somewhat reflected in markets. So if you think about the U.S. economy in general, we're in an incredibly privileged position. We only have two countries that border us. We have two massive oceans that divide us from most of the rest of the world, and we have a very diverse economy. So typically what we see is when there is geopolitical conflagrations around the world, the U.S. market tends to recover fairly quickly. Now, the exception to that, which you suggested, is oil prices. And that's often how geopolitical risk gets transmitted to the U.S. economy. So from that perspective, we've already seen this rise in oil prices put kind of like the U.S. central bank and other central banks around the world kind of on their back foot. We've seen a lot of central bank officials talk about moving from an easing stance to more of a hawkish stance. If that persists, then that is certainly a drag on economic growth. So in order for all of this to play out, we need to see oil prices stabilize and potentially start to come down again.
Well, to that point, we heard from Chicago Fed President Austin Goolsbee a little bit earlier today saying that he could see circumstances for a rate hike. Now, two caveats: he's not voting this year. And of course, he could see also circumstances reemerge for a rate cut. But still, it's in the conversation, to your point, that sort of hawkish bent. But let's say that oil prices stayed sort of near these levels, $100 a barrel or so for the next 2 to 3 months rather. I have to imagine that, you've modeled that out. What would that mean for the U.S. consumer and by extension, the U.S. equity market?
So in general, oil prices are not overly bad for the U.S. economy because we are on the margin a net exporter. So you have oil companies that really benefit from higher prices. But on the other hand, you have consumers, particularly low-end consumers, who are really hurt by it. And this is where you also start to see big bifurcation between whether or not we're looking at high-end consumers or low-end consumers. So before this conflagration even started, you had low-end consumers who had some benefit from the OBBA tax cuts, but that was offset by cuts to Medicaid and SNAP, also the higher ongoing mortgage rates. And you started to see consumers begin to pull back, at least low-end consumers pull back a little bit on spending. We've also started to see consumer sentiment pull in a little bit. So if we say have oil prices, as you suggest, remaining around that $100, that will continue to drag down that lower end consumer, which quite honestly then becomes a political issue because we have midterms coming up later this year. And in that sense, if oil prices stay high, gas prices stay high, consumers will start to blame the current administration for that and will start to vote in that way.
So that bifurcation between low-end and high-end consumers grows even more dramatic. Is that sort of an investable thesis at this moment? Or, when you take a look at a portfolio right now, is it still more about corporate earnings and perhaps where the Fed realistically could go in the next few months?
I think ultimately as an investor, there are obviously some certain companies that cater towards the low end or high end consumer. But in general, when you're thinking about a broad portfolio, it's going to be those things that you mentioned, corporate earnings overall, what the Fed is doing. And that's where the picture is actually really, really strong. When we look at S&P corporate earnings, we're expecting mid double-digit earnings growth going into 2026. That mirrors what we saw last year. And more importantly, we're also starting to see a big pickup in corporate earnings growth among mid and small cap companies as well. And so that's part of that thesis that we're going to see a broadening out in the market.
Kara, always a pleasure. Kara Murphy, CIO over at Kestra Investment Management, kicking us off to the close here on this Monday afternoon. When we come back, we're going to talk shareholder activism. It's shaking up CEO transitions and the appetite for M&A. A conversation up ahead with Hsieh Liekefett, partner over at Sidley Austin and the co-chair of the firm's shareholder activism practice. That's coming up next here on The Close. This is Bloomberg.
Shares of Synopsys rising on the news that activist investor Elliott Investment Management will make a multi-billion-dollar stake in the maker of chip design software and has plans to push for changes at the company. Here to discuss the shareholder activism landscape more broadly is Hsieh Liekefett. He is partner at Sidley Austin and co-chair of the firm's shareholder activism and corporate defense practice. Great to have you with us. Let's start with what we're seeing from Elliott and their peers, because it feels like Elliott in particular has been very active over the past year or so. And I wonder, does that say something about this environment that's sort of emboldening these activist investors?
It's a great question. Elliott is what we call the $80 billion gorilla, if you will, in the activism landscape. That's the amount of assets they manage. And they are, I think, accounting for, 20-30% of all campaigns, at least against large and mega cap companies in the United States. They're very smart people. That doesn't mean that they're always right. We are currently representing 4 companies, hopefully soon 5, against Elliott. But look, they do more research than virtually every other activist. They oftentimes spend years digging into the company, working with outside consultants, interviewing former employees, customers, etc., to come up with an investment thesis. And we always tell clients, look, if Elliott shows up, take them seriously, sit down with them, but you can't talk with them. Unlike other activists, they are open to the notion that they're not always right, which is a huge difference, because most activists have a hubris the size of Manhattan.
Well, you kind of touched on something I wonder about. If you do get a call from a company like Elliott or another activist investor, in your experience, what are some of the more typical mistakes that the target companies make in trying to deal and navigate having an activist investor?
Yeah, the initial instinct of a lot of companies is to hit back and how dare you criticize me? I'm a successful businessman or woman. And that's exactly the wrong instinct. And oftentimes we need to talk CEOs and boards off the ledge when Elliott and or others show up. And it's not always easy, because Elliott sometimes approaches companies privately. Sometimes they are semi-private, like with Synopsys, where they just leaked it to the Wall Street Journal. But didn't criticize the company all that much. Sometimes they go out with a 20-page letter without even having called the company, which makes it psychologically very hard to get everybody back on peace talks.
I am curious. I don't know if it's just me, but it also feels like the complexion of some of these campaigns are different. It would seem before you would get these reports, they would lay out what's wrong with the business, some improvements that could be made, give me a couple of board seats, and we'll be all copacetic. Now it seems like, the knives are out for the CEO, him or herself, sometimes for legitimate reasons, other times kind of a head scratcher. And I am curious if it has become a little bit more about the person running the company rather than the company writ large.
It's a great observation, Romain. That has really changed in recent years. I can pinpoint actually the time when it changed. It was 2023. I remember I was a guest speaker at NYU in a class taught by a portfolio manager of Elliott. And I asked him actually in front of the law students, well, it looks like you're not going after CEOs openly. And he said, Kai, why don't you give it a week? And surely enough, next week they openly attacked the CEO of NRG, a big utility down in Houston. And that started really a remarkable series of open attacks on CEOs. So why is that? Well, in the good old days, activists were reluctant to go openly after the CEO because they assumed it's harder to get an amicable resolution when you're asking for the head of the king, if you will. And it's harder to win a proxy fight if you are trying to oust a sitting CEO absent of a scandal, of course. But Elliott and others have determined, well, actually there are a fair number of boards who are perfectly willing to throw a CEO under the bus, in particular if things are not going that well, when faced with a prospect of a proxy contest. So the calculus has really changed in a lot of boardrooms, and we spend almost as much time these days talking to boards about remaining together as a unity than more talking about that than, okay, what are your chances at the ballot box?
Yeah, it's interesting. A lot of these never even get that far. I am curious, though, too. I mean, we talk about Elliott, and obviously they've been prolific over the last few years here. But there has been sort of a new kind of crop of, let's just say younger, maybe not as well funded, but certainly of younger sort of activist investors who are seeing some openings, particularly in certain pockets of this market.
Yeah, absolutely. Look, a number of the celebrity activists have slowed down, like Third Point, Pershing Square, basically Bill Ackman has stopped engaging in activism. Starboard is not doing as much as they used to be anymore. Elliott had a lot of departures. And, well, why is that? Well, I guess that's what a couple of $100 million will do to your ambition. I mean, you just focus on your yacht and your third wife and don't really go after companies anymore. Yeah. But there are a lot of young, ambitious activists out there who are now founding their own fund and go after companies. And oftentimes it's actually harder to deal with these newly founded activist hedge funds because they want to put their name on the map. They oftentimes have no interest in finding an early amicable resolution under the radar. They want to be on Bloomberg TV.
They want to be on Bloomberg TV.
Everyone does.
Kai, you should know that. But I am curious, though, too. I mean, also about this idea of sort of a new crop of companies that have come up that a lot of people will take a look at, in the digital asset space, whether we're talking crypto, stable coins, these digital asset treasury companies. We started to see some rumblings in that space as well.
Yeah, it's interesting, right? Last summer was like gold rush into DATs, as they call them, digital asset treasuries. And basically what these are companies whose sole purpose is to hold certain cryptocurrency. Why? Because there are a lot of investors who cannot directly invest in crypto, but they can directly invest in equity securities of a public company. So that was really the reason why a lot of these DATs got formed, oftentimes by taking over existing public companies and repurposing them. And unfortunately, the world has really not shaken out as much as those crypto fans were hoping. A lot of the cryptocurrencies have tanked in value, and by extension, of course, the market cap of a lot of these DATs have plummeted. So we see a lot of activists now thinking about going after these crypto companies. Right now, I think I represent 50% of all companies who are on a proxy fight with an activist in the crypto space. So it's a new frontier, if you will.
Absolutely. Well, Kai, we have to get you back to talk a little bit more about that. Kai Liekefett is partner over at Sidley Austin, of course, one of the top legal advisor for the past 6 years running, at least according to Bloomberg. When we come back, we're going to turn back to the situation in the Middle East and oil prices, the big drop that we're seeing on the back of President Trump touting the potential of a ceasefire with Iran. We're going to catch up with Arjun, Murti, partner of energy, macro, and policy over at Veriten when we come back after the break. This is The Close on Bloomberg.
Well, Cain is the lead developer on that One Beverly Hills project. Bloomberg breaking the news earlier today. We're talking about a $4.3 billion raise for a Beverly Hills resort here, Romaine. So clearly a big piece of property and a big piece of construction financing as well.
Yeah, I mean, it's this huge hole in the ground right now out there in Beverly Hills, right behind the Beverly Hilton. And obviously, this is going to be a huge project, at least when you look at the rendering. It's going to be anchored by, the Aman, big luxury hotel. But it really kind of gets to this idea of just trying to get a project like this, of this scale, off the ground, particularly in a city, let's face it, where, the regulations can be a little complicated at times. So it's interesting to see now, not only with the financing set, but obviously with that first pour really going in a few months ago and really starting to see potentially this thing start to rise into the sky.
The location is interesting. So, too, is the timeline, because construction began in 2024. The first phases are expected to be complete ahead of the 2028 L.A. Olympics here, which property is going to be in high demand. I'm one of those people who will be trying to go.
Are you? Yeah, so you're a track person.
I am a big track
Summer
person.
Olympics is your thing.
Yeah, but if you haven't rented, a house by now, maybe you're out of luck. Anyway, joining us live is Cain CEO Jonathan Goldstein. Jonathan, great to have you with us. Cain, of course, the project's lead developer. So just set the scene here for us as we were sort of laying out, really ambitious in scale, really ambitious when it comes to construction financing. How did it all come together?
Well, firstly, thank you for having me. And it's obviously a big moment for us to have brought together the financing, strong support from JP Morgan and Vici. But I think ultimately the reason that we've been able to do that is because we have a differentiated product. We have great location, great product, and hopefully great execution over the course of the next few years. And what it shows is that even in challenging markets, there is a flight to quality. And where you have a clear path to, distinction, genuine differentiation, then capital will support you at scale.
Yeah, so that's what I'm wondering about. I mean, obviously, this project, I have to imagine, is unique, but give us a sense of the real estate market overall, and especially maybe the more luxury side of things where you're used to operating.
Well, again, I think, it's about quality. It's about quality, location, product, and execution. We've been supporters and shareholders in Oman for a number of years, and what we're continuing to see is very strong, room rate growth over the course of the last few years, but as people seek out great experiences. And what we're doing in Beverly Hills is that we will be delivering the next level of experiences: privacy, luxury, security, the great amenities. And I think if you continue to double down and do this, then you have a great opportunity. And as you said in your introduction, we have a site here that has been vacant or fallow effective for over 20 years, but it's anchored by real history and cultural relevance in the Beverly Hilton, the iconic Beverly Hilton, the host of the Golden Globes and the home of the Milken Global Conference. And what we're bringing together with that real history and cultural relevance is a new product, high quality product, backed by the strongest hotel brand in the world in Oman. And we think that's going to produce real dividends for the local economy, for Beverly Hills, and for our clients and partners.
So, Jonathan, I mean, we've actually seen, obviously, finally, to see this structure get to the point where it starts to rise. But when we talk about having this ready by the 2028 Olympics, you think that target can actually be met?
So we have clocks now remain in every single one of our offices focused on the LA Olympics. So we're on, our commitment is to seek to deliver the hotel and the retail and the park areas by the LA Olympics. And that's what we're all focused on trying to achieve.
As we start to talk about sort of the demand for these types of properties, and obviously you're dealing with a very high-end consumer, obviously one that's going to be a little bit less affected potentially by any sort of economic shifts, if you will. But this is also becoming a more competitive space as well. And I am curious as to how you think you can differentiate yourself, not only, of course, with One Beverly Hills, but with the additional projects that you'll be working on in the future.
I think what you're looking to do is to attach yourself to the right brands and the right partners. We obviously have Oman in Beverly Hills together with the Beverly Hilton. We're also about to reopen the Delano in Miami Beach and South Beach over the course of the next 4 to 6 weeks. And we've seen, real excitement about the Delano coming back to the market, that iconic piece of South Beach. We've acquired the Dominic in New York to rebrand that as the Delano Soho. And what you're seeing here is a consistent theme of great location, great quality product with the top brands in their sectors in the marketplace. And if you can bring those things together and execute at the top level, then you have great opportunity of succeeding.
I want to talk a little bit about, where you see opportunity right now. Obviously, hospitality, residential, retail, that all makes sense. But, I mean, what do you think is an underappreciated area of opportunity that, you're looking at right now?
Well, I think if you look more generically, I think over the last few years, it would be fair to say that real estate's been somewhat an unloved asset class. We've seen great, booms in technology, in AI, in crypto and other marketplaces. But we've also seen over the course of the recent period great volatility in those markets. And I think what you're going to see is a return of a flight to quality in the real estate world, because people actually will feel more comfortable with the more consistent returns they will get from real estate. And I think what we have believed as a creed, Todd Bowley and myself, and developing this business, is that if we focus on quality and the best in the marketplace, we'll do well. We acquired and we developed the 830 Brickell office block in Miami, and we've achieved record rents in a fully leased up office block. And what you're seeing there is a great position, great quality, great asset. And I think what people are looking for is a quick road to income and a quick road to return, in addition to the right quality, the right location. If you can bring all those things together, I think people will be, that's where I see capital being attracted to in the medium term.
Well, Jonathan, I am curious. I mean, most of the conversations we have about real estate, obviously, the interest rate environment comes into play. There's a lot of questions about where exactly the Federal Reserve will go. But when you think about where you are in the market, that luxury space, that gravitation towards quality, I mean, how does what's going on when it comes to interest rates affect your business?
Well, I think the first thing that one should do, and I think, obviously a lot of people are suffering hardship at this point in time, and we hope that there is stability as soon as possible and that some resolution breaks out. And I think that's the most important point for all of us. And clearly we've seen great volatility in inflation, markers or in interest rate indexes over the course of the recent time since the outbreak of the dispute with Iran. So I think that is a real challenge in the short term. And clearly, the more prolonged period of instability, then the more prolonged period of interest rate volatility. Clearly the Fed, and also here in the UK where I'm sitting, a number of rate cuts that have been priced in for 2026, which have now been taken off the agenda. But I think we have to really understand that we're in a medium to long term game. We're not in a short term world. We're looking to actually invest over a 3 to 5 to 7 year period. And therefore, one needs to understand and hope that there will be that stability over that period, which will ensure that level of consistent returns that we're all seeking to achieve.
Well, not to put you on
clearly, the sooner from an economic perspective, I'm not talking geopolitically, that we can get that level of stability within the marketplace, the best for all of us.
Well, not to put you on the spot, though, would you consider if a new project came onto your table right now to invest in the Middle East, particularly in some of the Arab states like UAE, et cetera, would that appeal to you given what we know right now?
So as you may know, Romain, we entered into a partnership with Mubadala Capital in a recent time. And we've opened an office in Abu Dhabi, and we have a partner out there who's building a team. So, we're big believers in the Gulf, and we don't see that this short-term situation is going to affect our view about the Middle East being a significant growth engine over the course of the next 20 years for the world economy. So to answer your answer simply, we're already looking at something in Abu Dhabi, and we would have no qualms in executing that if we can reach agreement with our partner at this point in time.
All right, fair enough, Jonathan. Before we let you go, I do want to ask you also just a little bit about beyond just the normal hospitality and luxury properties you're dealing with. You've made some big expansions when it comes to some of the industrial sectors, supply chain sector, as well as some interesting sports investments as well. And I am curious as to exactly where you're trying to take Cain with some of these newer projects.
Well, I think what we've sought to do is that we've understood that as a younger firm, we need to create track records and have expertise in a certain number of areas and not try and be a master of all areas. So we've focused obviously on the luxury area very strongly. In Europe, led by my colleague Avi Luoma, we're focused on the industrial world. We've also got a very, very strong student portfolio in the UK that we're looking to take into Europe. And together with my partner Todd, who's obviously one of the world leaders in sports investment with his interests in Chelsea and the Lakers and the Dodgers, we've taken that into areas in our investment world. So we have our sports academy, the St. James, just outside of DC. We've an investment in a cricket team in the UK. And we've got other, experiential investments that we've found, very, very attractive, and we think are going to generate good returns. So for me, I think it's an issue of trying to focus on the areas where we have great expertise, great people, and great opportunities. And we think that will serve us well.
Jonathan, really appreciate you taking time for us today. We've got to catch up again. That's the CEO of Cain, Jonathan Goldstein there. Now, we do want to go to some breaking news down in Washington, where the U.S. Transportation Secretary Sean Duffy is speaking at LaGuardia Airport in New York. This about that Air Canada Express plane that collided with the fire truck overnight. Let's take a listen.
Were sent to the hospital after the crash. Several have also been released. As has been reported, the two pilots of the aircraft passed away in the crash last night. I do want to note that we send our deepest condolences to their families as they're going through, no doubt, a grieving process. There were two individuals in the fire truck. They too were sent to the hospital after the crash. Now, There's going to be a lot of questions, I know, about what do we know at this time. And what we are going to do is give you the information that we can. We all have the respect for the NTSB. The NTSB goes through a thorough investigation. And we are conscious about the information and the facts that we give you because we want that information to be accurate. There's some information that we hold back that the NTSB has that we allow them to do the investigation, and it takes months, sometimes up to a year before we get the findings of that investigation. But NTSB is on the ground at the airport. The FAA is on the ground. Over 10 people from the FAA are here, as well as Transport Canada is sending a team to LaGuardia as well. Our two countries work very well together. There's a well-worn path where we collaborate together when there's aviation crashes in either of our countries. The administrator and I were at the crash site earlier today, which is easily visible from the airport. And it's incredibly sad. It's troubling. And I just want to let America know that we are working our hearts out to make sure that when people travel, whether by rail or car or by air, that they travel safely. And we put in precautions and policies to make sure that you are safe when you travel. When I was at the crash site, it was just a reminder that when you're traveling by air, you should wear your seatbelt. If you see the videos of the air crash, wear your seatbelt when you're on the airplane. Also, in a car, wear a seatbelt. As you see from last night, they do save lives. I'd also note that as of now, LaGuardia is open. There is a reduced capacity because the aircraft and the fire truck are still in their positions from last night. So we are going to have reduced capacity for some time, but the airport is operational. Again, we'll come back and take your questions, but at this time I want to turn it over to the FAA Administrator, Brian Bedford.
Thank you, Secretary Duffy. Again, I want to extend my deepest sympathies on behalf of the 44,000 men and women of the Federal Aviation Administration. We take our responsibilities quite seriously, managing the safety of the air traffic control system and the national airspace.
And right now we are listening to the FAA Administrator, Brian Bedford, speaking there just following the U.S. Transportation Secretary, Sean Duffy, talking about that fatal accident late last night here in New York City, an Air Canada jet colliding with a fire truck that was on the ground. The two pilots are deceased, according to Sean Duffy. At least 40 people are injured. Sean Duffy also did say that LaGuardia Airport is open, but right now operating at reduced capacity. All right, we're going to keep an eye on that, and you can continue watching that press conference from LaGuardia Airport by typing live go on your Bloomberg terminal. But obviously a lot has been going on in the Middle East, and we do want to get back to that, particularly with the big drop that we're seeing today in oil prices. Brent crude down as much as 12% today after President Trump touted progress in talks with Iran. He said at an event in Tennessee that Iran wants to settle, and he hopes to get that done. Of course, Iranian officials have pushed back on that narrative, but nevertheless, you're seeing Brent, WTI, gasoline all moving lower, all as the industry-critical CERAWeek Energy Conference is in full swing down in Houston, Texas. Joining us right now from Houston is Arjun Murti. He is a partner of energy macro and policy over at Veriten. And Arjun, I do want to start off here with kind of the discussions that you're already hearing. I know this is more or less just day one of a week-long event, but we've heard from Mike Wirth over at Chevron. We've heard from the head of the UAE's national oil company. What's the general mood like, and what are people talking about?
You know, I think the Strait of Hormuz being closed, it is such an overwhelming and traumatic situation. It's hard to overstate how important reopening that is. And I think the conversation we're hearing today is about what happens after that reopens. It's the only assumption people can make. If that thing stays shut, it is simply not good news for the global economy. And that's true for regular people and governments, but it's also true at the end of the day for oil and gas companies. So the conversations are really focused upon, if we assume this strait opens, and we just have to hope it does, how do you think about running your company after that? And that's been the focus so far.
Well, I'm curious, we're focused a lot on supply right now, obviously with the Strait of Hormuz still effectively shut. But what is the interplay between, supply of oil being restricted, how that plays into what we're seeing on the demand side of things?
I have to tell you, I've been very surprised that the Strait has now been shut for several weeks, and there's already some signs of demand destruction or lack of availability of supply. It's more in various Asian countries. The futures prices that we see on our screen, things like Brent and WTI, understate the true physical impacts that we're already seeing. Crudes in the Middle East are going for over $150 a barrel. Things like jet fuel and physical delivery of these things is what I'm talking about. In some cases, are going for prices well in excess of that. And it really becomes a question, especially if you're in any number of Asian countries, how do you get physical supply? And as long as the Strait gets closed, the fact that we're already seeing that at a time where we all thought, or some people thought, there was some amount of oversupply, it's frankly quite shocking and troubling. The Strait has to reopen somehow.
Well, with regards to some of the temporary measures that have been touted, including by the IEA and the U.S. administration, as far as releasing reserves from the strategic reserves, is there any sense that, at least in the short term, that could help?
Every little bit helps. I think the redirection of Saudi flows on their east to west pipeline, the Fujairah pipeline that UAE has, the SPR releases, all these things on the margin help. But when you have an outage of this quantity, 20% of oil supply out, then maybe you can net that down to, quote, just 10%. That is still about 10x what I would say the normal flows could handle, the normal ups and downs of supply, demand, and logistics. So you're buying yourself days. You're not buying yourself months, let alone quarters or years. You have to figure out a way to reopen the Strait.
All right, that's a good place to leave it. Arjun Murti, he is partner of energy macro and policy over at Veriten. This is Bloomberg.
Our stock of the hour right now, well, we're taking a look at airlines as a group, up about 3 to 4% here on the day, with Delta and others helping move the whole sector higher. President Trump saying he'll pause strikes on Iran amid renewed talks between the two countries. Of course, this does not necessarily take into account some of the issues that we saw over the weekend with TSA and the chaos that we saw in those security checkout lines. Here to talk a little bit more about what's been going on in the airline space. Joining us right now is Sid Phillip, chief correspondent of global aviation over at Bloomberg News. Sid, all right, let's get right to it here. I mean, the airlines seem right now to be doing okay. If you hear them talk publicly, they're saying, look, we're still booking, we still have the ability to raise prices, but a lot of concerns right now about just about everything.
There is. I mean, at the moment, obviously security lines are the most pressing concern for the airlines because they need to get people onto planes quick enough, and that could lead to delays across the board. So we're looking to see, obviously the airlines are hoping that there's an end to the shutdown, at least there's funding for TSA in order for passengers to be processed quickly. In longer term, at the same time, the airlines are also dealing with higher fuel prices. And fuel is obviously the biggest expense, the single biggest expense for an airline. And so when fuel starts going past $100, that's when things start getting tricky for the airlines, and that's when they sort of have to start planning to sort of optimize routes, trying to see what yields are the highest yields and sort of cut back on unprofitable routes. And we're seeing some indication of that with United Airlines. I mean, Scott Kirby came out with a memo over the weekend talking about how the airline would reduce some of their unprofitable flying, their red-eye flights, in order to sort of make sure they don't keep a lid on costs.
Sid Phillip, unfortunately, we're up against the clock. Really great to get your perspective on a day where you're actually seeing airline stocks really surge here, Romain, sort of leading the charge when it comes to this equity rally that we're seeing. Of course, this comes on the heels of President Donald Trump saying that he basically told U.S. forces to postpone all of their strikes. You're seeing the reaction in oil and thus seeing the reaction in airlines.
Absolutely. And of course, that carries over into the broader equity market as well. Katie, as we count down to the close.
Yeah, joining us to help do that is Kevin Gordon. He is head of macro research and strategy at the Schwab Center for Financial Research. That conversation up ahead. This is The Close.
When you look at what the indexes have done over the last couple of weeks, over the last couple of months, the market really hasn't reacted all that much. And this is not to say that the conflict is not important. It is very important for the long-term trajectory of the U.S. and global economy. But I think what it's doing is that it's obscuring what is a more important shift in market leadership.
Kara Murphy over at Kestra Investment Management kicking us off to the close just about 15 minutes ago. Katie Greifeld. And this is a big turnaround from what we saw in futures markets earlier this morning, where you saw stocks down more than 1%. And then, of course, we got those headlines out of the president around 7 a.m.-ish hour. And that really just lit a fire under the bulls.
Absolutely.
Yeah.
Coming out before the market opened, saying that they're going to set the U.S. is going to set 5 days for Iran talks, so that'll cover the entire trading week. I will say, even though we're going to finish, more than 1% higher, assuming this holds, we're well off of session highs. The interesting move, once again, is what you're seeing in Brent, down 11% on the day, trading back below $100 per barrel. But just for context, coming into this conflict, Brent was closer to around $70 a barrel, so still quite a climb there.
Yeah, and that could be the potential risk here, that even if we do come down, the idea is that we still might stay elevated. And whether that poses any real risk here to corporate earnings, that could be the big question going forward. Kevin Gordon joins us right now, head of macro research and strategy at the Schwab Center for Financial Research. And Kevin, that is where I want to start. This idea between what you call the front page risk, the headline risk out there, and the bottom line risk. And we've had several guests on this program talk about this, sort of like, wake me when this really starts to affect corporate earnings.
Yeah, and I think for this, you can actually even bring it to what is a consumption shock versus what is a labor shock. I think that's ultimately the distinction that sort of has to be made, because you can look at something as, as real time as initial jobless claims that we get every Thursday morning. Those have been trending lower over the past couple of weeks. So there hasn't yet been this material flow through to the labor market. Not to say that this crisis won't matter for the average consumer, because clearly there is going to be a relatively large inflation shock, and there already has been, by way of gas prices for everybody who drives. So I think there's certainly going to be pain felt, but whether it translates to this broader weakness that's going to spread over the labor market, I think that is the real question in terms of the market pricing this in, to be something akin to a correction or even a recession at this point.
Well, this gets to the idea too. Obviously, Jay Powell wanted to steer clear of the word transitory, but there are a lot of folks in the market kind of looking at this in that same way, that even if there is some degree of pain, economic pain, that it will likely be relatively short-lived.
Yeah, I mean, I think, the hard part about this is that, and 2022, unfortunately, is kind of the only analog that we have, because it was the most recent, and it was at the time when we were the net oil exporter, and we were, relatively insulated from the world in terms of the energy, independence and the energy intensity. The hard part is that even for something like labor, non-farm payroll growth was running above 5% at the time Russia invaded Ukraine. Today, it's just slightly above zero. So you do have more of a growth risk. It's just that the growth profile, though, of the U.S. has really shifted over the past year and a half, where business capex, especially in the AI side, has really been doing a lot of the heavy lifting. So coming into this year, consumption was already looking relatively soft. The trend had really softened, not near recessionary levels, but certainly not anything consistent with an economic boom. So the question, and again, back to the distinction between the consumption shock and the labor shock, is if you're really going to have that much of a hit to business capex at the end of the day, if businesses are going to start losing out on revenue and then they're not able to spend as much, that's, I think, where the mechanism is ultimately going to matter the most.
We want to talk about sentiment in this economy a little bit more, because sentiment, I mean, it's squishier, and how it actually translates into the hard numbers, that's up for debate. But I'm taking a look at the notes you sent over to our producers. You write that jobs and GDP, that picture underscores persistent vibepression. I've heard of the vibesession. I haven't heard of a vibepression, and I'm wondering what that is.
Yeah, I'm just building on a term from my friend Kyla Scanlon, who came up with vibesession. But to me, when you're 5 years now into this, where consumer sentiment has stayed, 5+ years, where consumer sentiment has stayed at almost depression-like levels. Some of the metrics consistent with what we saw at the depths of COVID, some of them consistent with what you've seen in the depths of the financial crisis. And you square that with the fact that household net worth as a percentage of GDP has gone up, as a percentage of disposable personal income has gone up. All of these asset markets, even over the past few years, with these shocks included, have done well. But the average consumer doesn't necessarily feel that. I think that's sort of a direct reflection of what's happened, number one, in the first phase in the inflation environment, and the fact that price levels are still egregiously high for the average consumer. But now, number two, all of these deeper concerns over the labor market. Not just the slowdown in job creation over the past year, but this general concern, and it does skew younger in the age spectrum, but this general concern over AI.
Have you heard this phrase, the E-economy? Everyone kept talking about the K-shaped economy.
So many letters.
Now we're on to the E-shaped economy, which
What's
seems
the middle?
The middle is basically the middle income people. The idea is the
and
K,
that shorter part of
shorter,
the E.
and the idea, this just came to my attention last week because the Macy's CEO used.
We have all these different letters of the alphabet, and all the
you
different.
could pick any letter. I mean, you could do I for instability. We called it that at the beginning of the year. I mean, there's a lot of different ways.
Perhaps that's just a circle.
Absolutely.
We always come back to circles on the
We've
close.
become Sesame Street.
I am curious, though. I mean, that has been sort of the story of this post-pandemic economy. That by sentiment measures, consumers are miserable, but they're still spending money, and I wonder, if that sort of translates into a long-term investable theme. I mean, what does that mean for someone's portfolio if you take a look out, not over the next year, but the next several years, the next decade?
Well, I sort of think that we're living it a little bit now, where and housing is really at sort of at the central piece of this in terms, especially when you skew younger down the age spectrum. So many people feel that they've been, locked out of the housing market for good reason because of both home prices, but also mortgage rates. That has pushed a lot of younger people into the equity market in particular, in terms of how they feel they can build their wealth. So to me, that retail trader and retail investor cohort that has become so dominant, over the past several years, really post-pandemic, I do think that it sort of pushes around volatility, it makes markets a little bit more volatile, especially when you get to that cohort that is a little bit more reactive off of some of these headlines. So, perfect example is a day like today. We've had such an extreme inverse correlation between Brent crude and the S&P 500. It's almost perfect on an intraday basis in terms of negative 0.9. But when you get as much of a reversal as you have based on a headline this morning, that cohort kicks in and starts to move markets around a lot more. So I think that it's starting to manifest a lot more. Longer term, to me, it's a little bit probably more of a deficit and a rate story just because of the need or the desire that a lot of people have for government support because of affordability issues. But I don't think that's something that manifests in the short term. I think the short term is more of an equity market story.
All right, Kevin, great insights. Kevin Gordon is head of macro research and strategy at the Schwab Center for Financial Research, counting us down to the closing bells and seeing some selling pressure, Katie Greifeld, as we get towards those bells, not quite at the lows of the day, but getting there, still holding gains. So.
Absolutely. The S&P 500 now 1.2% higher again. A lot of people will take it after what we've seen the past few weeks. But session highs, we were about 2.2% higher, so have almost halved that.
And we should point out here that the volatility in this market does remain despite the upside swing. A breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar, Tim Stenovic, they join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. Another wild day, Carol Massar, on Wall Street, but it actually started before the cash session back in the futures market in the wee hours of around 7 a.m. I know you were probably still asleep here. Markets were down.
On my second cup of coffee, dogs were walked. I was reading through the Bloomberg.
Took off for a rally.
Messaging with my producers. No, you're right. It was very different overnight and certainly early on. And then, President, obviously, maybe some would say watching perhaps the markets, but we did get some commentary from the president on Truth Social. So kind of holding off, backing off on his ultimatum, if you will, to Iran. And so we've got now 5 days. So the clock is ticking and we'll see whether or not there are talks going on. But risk on trade, guys, most names we are seeing in among the big caps, the S&P 500, they are higher today.
Most equity names higher, but look at oil. We have Brent below $100 a barrel. Katie, 99.70 right now. WTI, 88.70. We had a great conversation with Jayati Bardwaj over at TD Securities a little earlier today. And she said, don't get excited so quickly here. Right. She sees like a real floor at $80 a barrel. She doesn't see us going back to $60 a barrel anytime soon.
We'll see. I do just want to point out gold down today, 2%. Once again, this is a 9th straight day of losses for gold. That is your longest streak since October of 2023.
And just a reminder here, still no ceasefire. In fact, getting headlines right now out of Israel that the IDF is already detecting launches of missiles from Iran. So a situation that is still fluid. The Strait of Hormuz now closed for a 24th straight day. Wow. Meanwhile, investors are trying to hang their hats on optimism that yes, maybe indeed there are talks and maybe we could see a ceasefire potentially sometime this week. The Dow Jones Industrial Average adding 600 points or 1.4%. The S&P up 75 points or 1.2%. The NASDAQ Composite adding 300 points or 1.4%. And the Russell 2000, that's your outperformer, about 56 points higher or 2.3%.
All right, we are definitely living from headline to headline on this U.S. war in Iran. Back to the S&P 500. Earlier today, we had more than 400 names to the upside. Katie, still about 382 gaining ground on this Monday. 120 to the downside, one unchanged.
Well, it was a perfect score when it comes to the sector picture. 11 out of 11 sectors in the green. Haven't seen that for quite a long time. Consumer discretionary leading the pack in terms of your percentage gain, higher by about 2.5%. Materials also 1.5% higher. So too was tech. Healthcare almost spoiled the picture. Healthcare as a sector higher by 0.03%, but the color is green, Carol, so it's going to count.
Wow, kind of love that. All green. I had a lot to choose from in terms of individual gainers, so let's get to it, folks. Two names, DraftKings and Flutter. Certainly some outperformance there in the trade. That has to do with these two names gaining after the Wall Street Journal reported that U.S. senators are set to introduce bipartisan legislation to ban sports bets on prediction markets. So this has certainly been giving the likes of DraftKings and Flutter kind of a run for their money. Now, the bill pertains to entities regulated by the CFTC, including prediction market exchanges, Kalshi and Polymarket, according to the newspaper. As I said, these two names, though, have been under some pressure as investors fret over the competitive threat posed by Kalshi and Polymarket, which have seen volumes tied to sporting events boom. So we're going to keep a watch on that one. DraftKings up more than 1% and Flutter up about 4.4%. Flip it on over to the cruise lines, also getting a kick to the upside, and they were among your top gainers in the S&P 500. Norwegian up more than 6%, and you're looking at more than 5.5% gains on both Carnival and Royal. And this basically has to do with what's going on, at least some of the headlines out of the president when it comes to the war in the Middle East and in Iran. President Trump backing off those threats. So we did see the whole travel sector actually gaining in today's session. So some optimism coming back. And then one more name I just want to throw into it is Palantir. That went up almost 6.8% in today's session. Top in the NASDAQ 100 as its Maven artificial intelligence system will reportedly become an official program of record for the Pentagon. You might remember on Friday, our own Katrina Manson, she's got a new book out that's all about Project Maven that's been developed over the last decade or so. She reported on Friday how the Pentagon intends to accelerate AI-enabled decision-making and put it at the heart of its ambition to link up sensors and shooters for combat operations. That was according to a policy memo seen by Bloomberg. So she kind of front run.
Very cool book,
Something
too.
like that. It is an incredible book about what the government's been working on.
Hey, how about some decliners not easy to find
It's called
today?
Project Maven.
Project Maven.
Okay.
Katrina Manson, man.
She's
if you
amazing.
haven't talked to her, you should.
I haven't, but thank you.
Okay, you're welcome.
Let's start with Micron. Shares down 4.4% today, down for a third day in a row after the company last week reported CapEx for the year that was higher than analysts wanted to see, down more than 13.5% since those highs just after reporting last week. Also want to talk about shares of Pfizer, kind of hovering lower by about 0.7% for much of the session. That's where it finished. This after the company said its experimental Lyme vaccine was only 73% effective against Lyme disease. It's a lackluster result, as fewer than expected infections in the pivotal study made its potency hard to evaluate. There's currently no human vaccine for Lyme disease on the market. Also, late in trading, we saw FICO, Fair Isaac Corp shares take a hit today. This after Politico reported that the company is being queried by Senator Josh Hawley for its mortgage credit scoring. Look at this, down 5.7%. Politico reported on a letter that Senator Hawley sent to FICO that said, quote, "These price increases are most damaging to the Americans who can least afford them. First-time homebuyers bear a disproportionate burden of the cost." Once again, FICO shares falling by 5.7%. And a late ad, big thank you to the control room for throwing this one up there. Estee Lauder Company's shares late in the session down 7.7%.
This is amazing.
This is wild. The FT reported the company's nearing a deal to combine with Puig Brands. It's a Spanish beauty firm. The transaction could be announced as soon as Monday, according to the newspaper, who cited people familiar with the matter. Estee Lauder shares down 7.7% today.
Yeah, I thought it was interesting, too. I was also curious as to why it dropped so much here. Obviously, we don't have all the details, but you also saw some of the other peers in that space get dragged down, like Cody. Meanwhile, we talk about the moves in the yield space here, and it was one of the most volatile days that we've seen in quite some time for Treasuries, if you can believe that. On a points basis, when you look at the two-year yield, we actually had the biggest one-day swing from peak to trough in two-year yields going all the way back to August 1st of last year. Down 11 points at one point, up 11 points at one point, closing out the day down by about 5 basis points here. Similar moves across the board here with your 10-year down about 3 basis points and your 30-year yield down about 2.
All right, guys, it feels like in some ways, despite our focus on traditional markets, if you will, public markets, we are talking a lot about the prediction markets. And there was an interesting story that caught our attention. This has to do with Polymarket updating its rules to clarify that certain kinds of trades are prohibited, including acting on stolen confidential information or wagering using illegal tips. You feel like, yeah, of course it should be this way, but nonetheless, they got to come out and say it, Tim.
Look, these prediction markets are trying to figure out how to make their platforms not just appeal to more people, but also less so the target from and of regulators and lawmakers. Axios also reporting this afternoon that Kalshi plans to block athletes, coaches, and officials from betting on their sports and block political candidates from trading on their campaigns. I expect we're going to hear more and more from these companies as they try to tamp down on.
But how do they do this? I mean, because there's been so much speculation, and particularly when it comes to some of these prop bets in sports and the idea of who is really behind some of those bets here. I mean, let's face it, some of those athletes are also, actually, ambassadors for these brands as well.
Mm-hmm.
Yeah.
Also, you can ban athletes, you can ban politicians as well. But you think about some of the insider activity that's been alleged when it comes to some of these platforms. I mean, it also extends to geopolitics and war as well. So it feels like when you're in these sort of situations, it's sort of whack-a-mole. You're not going to be able to sort of police everything, but at least the companies, coming up and making some sort of stand here. The enforcement's still a question.
All right. Well, it's certainly an important topic already this year, and maybe tomorrow we can talk about Romaine's luxury ride and how he gets to work. So that's kind of a deep tease, perhaps.
I'm his driver.
Are you?
Yeah,
on the back of you signed an NDA then, that means.
It's actually where we discuss the whole show, and he kind of reads me in.
Tim, you said too much. Whatever happens in the Maybach stays in the Maybach.
Yeah. I thought it was on the back of his bicycle. That's how he gets to work. Oh. All right, guys, that is a wrap across platform. Radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Kitty and Romaine continuing there on the close on Bloomberg TV. Tim and I back here on Bloomberg Business Week Daily right here on Bloomberg Radio. We will see you again. Same time, same place tomorrow.
Big moves in equities, big moves in oil, big moves in treasuries, and also big moves in the world of FX. We're going to break it all down when we come back after the break. We're Carlos Fernandez-Aller, co-head of Global FIC Macro over at Bank of America Securities. Stick with us. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. We had a wild day on Wall Street that actually started in the pre-market. During the futures session, we saw the S&P 500 futures down about 1%, but some commentary by the President of the United States intimating that there were actually some talks between the U.S. and Iran and the potential for a ceasefire. That lit a fire under the markets. The S&P at one point was up almost 2% on the day, pairing some of those gains into the close, but still closing higher. A big part of the reason was that 11% drop we saw in Brent crude, a slight dip that we saw in Treasury yields, and even the dollar, that dollar strength that has been in the hallmark since the war began about 24 days ago, that moderating today as well.
Well, let's talk about some of the makeup of that rally that we saw in equity markets. NVIDIA higher by about 1.7%. This was your biggest points contribution to the upside when it comes to your big index there. But even with this update on Wall Street, there were some notable decliners. We talked about them a little bit in the simulcast. FICO down another 5.7% today. Political reporting that its mortgage credit scoring business coming under scrutiny. And then this was a late mover. The FT reporting that Estee Lauder actually in talks to combine with a Spanish beauty firm. We don't have the details when it comes to price tags or anything, but it sent shares lower by about 7.7%. Let's get to our top story this hour, though, and that is a possible de-escalation in the Middle East, really rippling through markets. As Romain mentioned, you have oil falling, stocks rising, and the dollar retreating as President Trump postpones military strikes against Iran's energy infrastructure, saying that the two sides had productive discussions. Meanwhile, on the other hand, though, Iranian media denying that negotiations have taken place at all. Our next guest weighing in on these market moves, saying, quote, the U.S. dollar has been perceived not so much as a traditional safe haven, but as a relatively insulated from the economic fallout of the conflict, Romain.
All right, well, let's get some more from him. He joins us here in studio right now. Carlos Fernandez-Aller is co-head of global macro trading at Bank of America. So what does that mean, Carlos?
There's two reasons why we have seen all this large move in dollar strengthening. The first one is one of relative impact. The dollar, at the end of the day, the U.S. is an energy exporter. So the impact of a higher oil price is significantly smaller in the U.S. rather than in other pairs like Asia, which is very impacted, and Europe. The second reason, and we will see as if the war extends, if we enter in a more prolonged higher oil prices, the dollar will continue strengthening. The other side, and this is something that has not been discussed enough, at the beginning of the conflict, the market was heavily positioned short dollar and long in emerging markets. We all believe that this was the year for emerging markets. And clearly, the playbook changed completely with the conflict.
Well, has it changed for good, or is there the potential that, assuming that this war finds some resolution and we start to see oil and energy products get back through the Persian Gulf and out to sea, can that sort of reverse that damage or mitigate that damage?
It depends on the extent of how long this continues, and it depends on again, how long will it take to reopen the oil traffic. At the end of the day, what this has created is a lot of discrepancies or price dislocations. At the beginning of the conflict, again, there was an almost indiscriminate unwind across emerging markets, including currencies that should not have been impacted, that were including metals. We're talking, we can see how gold has moved, despite the fact it's supposed to be a safe haven. So when this is over, and I have no idea when will that be, there will be a lot of trading opportunities coming from these dislocations.
I do want to talk a little bit more about dollar positioning, because that's an interesting point. That, I mean, coming into this market was short dollars. You got the CFTC positioning data on Friday that showed that speculators, including hedge funds, had flipped to actually long positions. So I'm curious, what's your sense of where this market stands right now? Are we back to neutral when it comes, again, just to the positioning of this market?
No, and that's an excellent point, and linking to exactly what you're saying. We were very short dollar, and we were very convinced that this was the emerging market year. Now, due to this large unwind, we have moved the other way. Thus, if we see a resolution, I will not be surprised if we come back to the trend that we have been over the last 6 months with significantly dollar weakness. However, again, it depends on what kind of resolution we have.
And I do want to get back to a point which we were talking about in your introduction, that, you know, the dollar's rise that you've seen, maybe it's more about positioning, not so much about its haven properties. When you take a look at the FX landscape, I mean, are there any true havens left? Because it feels like the yen has been unreliable, and I couldn't tell you where the Swiss franc is right now.
Actually, that's a really good point. I don't think they are. Traditionally, the textbook will tell you gold was supposed to be a safe haven in moments of high inflation and war, and yet it has dropped 20% in the last 4 weeks. The dollar, again, almost by default, because it's less impacted than other currencies, has performed very well. But we are now in a world in which havens are very difficult to find.
I am curious. I know there's been a lot of talk about the interplay between the U.S. dollar and some of the emerging market currencies. But with regards to the developed markets, the euro, yen, I guess to a smaller extent the pound, is there a sense here that anyone would actually seek out those currencies over the U.S. dollar as a potential haven if this does continue?
I think what has happened in Europe has been remarkable, not so much in the currency world, but in the rates world. We have moved from pricing zero hikes to 50 basis points of hikes, both in Bank of England and ECB. There's a lot of volatility coming there. There's a huge amount of concerns related to inflation. So I don't perceive that as what investors are going to seek as a haven. Renminbi, China has been performing relatively well because they're pretty isolated to everything that's happening for now. But again, it's not a currency that people will find. The only reason yen is not weakening more is because people are scared of an intervention around 160. It's very difficult to find a good place to put your money now.
Wow. All right. Well, Carlos, we have to end it there. Carlos Fernandez-Aller is co-head of global macro trading over at Bank of America. Katie?
Coming up next, we're going to dig a little bit deeper into the market action, particularly when it comes to equities, with Julian Emanuel of Evercore ISI next. This is The Close on Bloomberg. U.S. stocks rallying following Friday's close, which saw the S&P 500 approaching correction territory. Julian Emanuel, he is Senior Managing Director of Equity, Derivatives, and Quantitative Strategy over at Evercore ISI, joins us now to discuss. So, Julian, of course, a big relief rally that we're seeing today. There's a lot of questions over how long this reprieve might actually last. But I want to talk a little bit about oil here, because I'm reading your notes and you highlight that oil and gasoline is what matters right now. And in a market that's been looking for a Trump put, maybe we found it in some of the levels that oil actually reached last week.
Extremely important. All the work that we've done looking at past cycles over really decades says that certainly from the point of gasoline at the pump, $4 is a very sensitive level for the consumer. We saw that in 2022 and in 2008. It changed behavior. It caused a market downturn and an economic downturn. And so it's fascinating that the regular price on the Bloomberg screen was $3.96 this morning. And here we have, some relief, very important. And also when you think about West Texas Intermediate, is that it's not so much the absolute level, but it's the deviation, the speed of the move. So we look at the 24-month moving average, and when you get to 35 to 50% above that moving average, that's when the alarm bells sound. They started sounding between 93 and 98 a barrel. And the market and the economy and the consumer psyche just is not built to take that for an extended amount of time. We sort of see 2 to 3 months as the window. You're in day 24, but this is a very welcome relief in the energy markets.
And we were talking about it with Kevin Gordon, and he made the point that, you take a look at the day-to-day correlation between oil and between stocks. It's almost perfectly inverse over that period that you mentioned. So, is this just the foreseeable future? If you're an equity trader, if you're a bond trader, you're just laser focused on where oil is going?
No question about it. No question about it. Again, it's the sensitivity of both the price and the time that we're spending at these prices. But also, look, we have to face it. It's not unlike this time last year, where the short-term direction of the market was really driven by, tariffs on, tariffs off, et cetera. Similarly driven by what the discourse is going to be between the Trump administration and Iran.
Absolutely. I am curious about the moves that we've seen in the yield space. Obviously, that's directly correlated with what we saw with regards to oil prices and the inflationary concerns here. Do you think, though, assuming that we are on a path to some sort of détente or whatever we want to call it, do you see that we'll see a significant pullback in some of those yields? Because that seemed to be inflation pricing or pricing in the idea that maybe the Fed would even hike rates this year.
From our point of view, we think pricing in a Fed rate hike here is, I guess, misguided is a polite way of saying it. And the reason we feel that way is that if you look at other assets, specifically gold, copper, aluminum, the metals, which have all plunged in the last week and a half. Gold obviously was down enormously this morning before stabilizing. That's telling you that the market really shouldn't be that convinced that this is going to be a strictly inflationary shock. In 2008, the oil price spike was, patently deflationary and recessionary. in 2023, once we got past 2022, it was transitory. It's an open question. And for us, both on the short end and the long end, we do think there's relief in sight.
With regards to the short term and what we've seen in prices today, I mean, how much of this was just sort of people kind of positioned wrongly? I mean, there's been a lot of talk about the move higher we saw today was probably partly the result of a short squeeze. Similar story with the moves that we saw in the dollar and in other assets as well.
There's definitely an element to that. Look, what's been amazing to us in going back to experientially back to the 1990s, the original Gulf Wars, as a young desk trader, we have never seen the degree of hedging across stocks, credit, and bullish oil all together that we've seen in the last 5 weeks. No precedent whatsoever. So what we had at the end of last week was people ready for the move that we had. And then, frankly, this is very much a sort of a systematic thing. You got your weekly close below the 200-day moving average in the S&P and the NASDAQ on Friday, and that tends to lure the systematic traders in on the short side. And from everything that we can tell, was really the perfect grounds for a bear trap, which we saw today.
Yeah, I'm curious, I mean, what kind of conviction you're seeing behind the rally that we saw today, for example. If you look in the options market, I mean, are you seeing any people, really stepping up to buy calls, for example? I mean, has this been accompanied by any sort of that behavior?
No, not yet. Today was sort of a, jaw-dropping event at the scope of the moves. And frankly, we started our morning meeting at Evercore ISI by talking about how the downside volatility was manifesting. And then in the middle of the meeting, the tweet came out and you basically ran, reversed 150, 200 S&P points in a matter of minutes. And the dialogue completely changed. But when you have that kind of move without really being able to evaluate and also knowing that it is beholden to political dialogue, which none of us are really party to, there's a tendency to just wait and see, and that's what we have right now.
All right, Julian, always appreciate your insights. Great stuff as always. Julian Emanuel, Senior Managing Director of Equity Derivatives and Quant Strategy at Evercore ISI. And Katie Hsieh was speaking. We actually heard from San Francisco Fed President Mary Daly posting on X saying that the Fed needs to stay flexible with regards to monetary policy given the risk. But I thought this was interesting. She said the economic impact would be short-lived, assuming that the war resolves quickly, and also says that too much forward guidance risks a false sense of certainty.
Interesting. So maybe she's suggesting that they should be speaking less then.
Yes.
That's an interesting sentiment there. I mean, when it comes to sort of the uncertainty over this moment, we pretty much heard the same from Jerome Powell last week at last Wednesday's meeting. And I mean, even with Mary Daly's suggestion, it feels like we've been getting a lot of Fed speak. So,
and there's more on tap.
Who knows? We'll still head on the close. Elanco CEO Jeff Simmons, he joins us next on the heels of his address to the National Press Club on the future of protein demand. This is the close. Well, rising pet care costs haven't been enough to stymie business over at Elanco. The key is innovation based on the company's most recent earnings report, which was underscored by momentum from its companion animal offerings. Joining us live from Washington, D.C., where he just addressed the National Press Club, is Elanco Animal Health CEO Jeff Simmons. So, companion animals, we're talking about pets, but let's talk about the other side of your business, and that, of course, is more livestock, because you're down in D.C. to talk about the future of U.S. agriculture and protein demand. And on that note, I am curious, whether or not what we're seeing in the Middle East right now factored in to the discussions that you've been having today, because certainly, as you've seen fertilizer prices rise, you've seen grain prices rise, and I have to imagine at a certain point that filters into things such as cattle, Jeff.
Yeah, absolutely. That's a factor. But, we come back. Yes, today's been a lot about the protein craze that's going on. Katie, you and I have talked about it, from meat sticks to cottage cheese to yogurts. Where we are today to maybe 5 years ago when people were saying, is meat and that have a future? And we've seen meat sales double the last 5 years. Now we got dietary guidelines recommending double the daily requirements. And all of this has really created a craze. And I would say, yes, there's no question. There's lots of dynamics out there right now. But I think to the American livestock farmers, the big focus right now is, hey, let's make sure we've got the innovation and the competitiveness to take advantage of a market opportunity that we see is going to have quite a long runway here domestically, right here in the U.S. It is happening globally, but I think domestically it's a great opportunity.
And when we were together at the JP Morgan Healthcare Conference in San Francisco back in January, we were talking about this cattle shortage that's underway in the U.S., how that's impacting Elanco. And I was hoping that you could just give us an update here because, we're sitting here at the end of March. How are things looking when it comes to, the herd shortage that we're seeing in the U.S.?
Yeah, it takes a while to build back the beef herd. So we're talking about the beef cattle in the United States. And it takes a while to actually build that herd back. And we've seen that come back, but it's coming very slowly. It's going to take some time. It takes, 3 to 4 years to build that herd fully back. So it will be some time. But I would say the American farmers have stepped into the challenge, all sides of the protein. But on the beef side, they're taking advantage of innovation. They're taking advantage of keeping cattle a little longer so they can actually, create more protein and doing the best they can to sustain that competitiveness and continue. It's all about accessibility of protein. It's all about the affordability of that, as you know, Katie, and that's what we're focused on. But I would also say, as you spread out and look at the dairy industry, you look at poultry and pigs, we're number one right now in all of those major segments. And what we're seeing today is, farmers are looking for the freedom to operate. That's what got them in the business. And American farmers are as competitive as any farmers. They need innovation and they need strong markets. And today they're seeing a market. There's differences around the country between different segments and different protein groups. But as a whole, everyone has a pretty robust outlook. And that's what we talked about today over the next 5 years for the American farmer that's creating this protein.
I am curious, though, Jeff. Are you already seeing or getting hints here that we are going to see an increase in production? And my question to you is, A, do we have the capacity here in the U.S., both the land capacity, but also the capacity, of course, with regards to what you produce in order to be able to treat these animals and make sure that what we're getting to the table is safe and healthy?
Yeah, the answer is clearly yes. And I know that the American agriculture is up for this challenge and this opportunity because it is a big opportunity. And yes, we do have that. But I will come right to our business, animal health, and the role that we play. And really to answer that, Romaine, without question, it comes back to innovation and the need for innovation. Farm animal is actually bigger than pet health. And why this industry, animal health, is so durable and so strong is you've got a pet business and this whole humanization of pets, as we've talked about. Now you've got this protein craze, but innovation. So let me just give you a sense. When you look at the protein overall, we've got about 20% that's lost to health and productivity overall. If we could close that gap globally, we could feed somewhere in the neighborhood of 1.5 to 2 billion more people. So the opportunity for health and wellness, respiratory, mastitis, just the basic husbandry diseases, if we can handle that, we're going to create the productivity with really the same number of animals and no additional, land usage or water usage needed. So the health and the well-being of an animal creates a stronger farm, creates more accessible and affordable meat, milk, and eggs for the American consumer. And that we know is absolutely essential today in today's environment.
Do you need more help right now from Washington with regard to the regulation and laws on the books, or can you do this with what we have?
Look, I think we always say, hey, I think the opportunity to have, less regulation and freedom to operate, drives productivity in American business and American agriculture. And I know that's what American farmers want. They also need predictable, great innovation coming through. And I will tell you, the pipeline of innovation in farm animal has never been more robust. I mean, for us, we're looking at historical innovation right now that we're launching into the marketplace, like a key product that we're launching, Experior, in the beef market that's been critical to this beef shortage, but also the next generation. Look at monoclonal antibodies, highly used in human pharmaceuticals, used in pets. We're working at bringing them to solve, it's a targeted, innovation. It stimulates the animal's immune system and really decreases the need, for other products. It's a cleaner way to bring, what the animal needs and what the consumer wants. So we've got the innovation to do this. Innovation's critical to the American farmer to stay competitive. And that's what we're asking for here in Washington is, continue to deregulate and create a more competitive regulatory system to bring innovation.
Well, Jeff, we appreciate you making time for us while you're down there. That is Elanco Animal Health CEO Jeff Simmons. Really interesting conversation as this entire nation refocuses on protein, Romaine.
We're protein crazed, Katie
Yeah.
Greifeld. It's not just eating the animals, but it's, putting it on top of your latte.
Oh, yeah.
Chips now.
Oh, yeah.
Injecting protein.
I had protein chips yesterday, actually. They were okay.
I had no protein yesterday. All right, when we come back, we're going to switch from what's been happening in the protein sector and talk a little bit more about shopping. And we're talking about in-store shopping. It may surprise you here, but it's actually going through a little bit of a renaissance. A conversation up ahead with Jack Hsieh, the CEO of Macerich. That's coming up next here on The Close, right here on Bloomberg.
Sometimes people talk to me a lot about, wow, people are shopping in the real world again, and they're going to malls again. Malls are alive and thriving.
The mistake we sometimes make as retailers is go with a curve and try and say that is going to perpetuate itself into the extinction of stores. And I'd argue that, no, you actually see people going to stores, and where they browse and where they buy is up to them. And they may browse online and buy in store, and they may browse in store and buy online.
5 years ago, during COVID, people shopped online, and everyone loved e-commerce. Fast forward to today, e-commerce sales and brick and mortar sales are converging.
Well, if you want to get this customer to come shop with you, you have to give them experience. That's what they're looking for. It's customer service could be part of that experience. I think what differentiates an online experience from an in-store experience is customer service, customer service.
That was just some of the major players we've spoken to in the retail space, and we're going to add one more to the program right now, a big one. Jack Hsieh, he's the president and CEO over at Macerich, one of the country's leading owners and operators of malls, joining us exclusively for his first TV interview since taking the helm. Great to have you here.
Thank you.
You heard those folks, and anyone who's walked around a mall, particularly one of the more higher-end malls, you can see there's a lot of traffic. And I'm curious kind of what happened, because I feel like a few years ago I was told that the mall was dead, retail brick and mortar was dead, but we are seeing a bit of a revival, and it seems to be driven by not, our generation, I was going to say older people, but our generation, but Gen Z and some of the younger folks.
No, absolutely. Yeah. In the United States right now, there are 1,000, roughly a little bit over 1,000 super regional centers.
Yeah.
And about 230 are ranked Class A- or higher. Luckily for our company, over 90% of our property NOI comes from Class A- plus centers. And what's happening right now is they're reconfiguring anchors right now. So our strategy is, at our company, we're leasing 1,000 new units in our portfolio out of a base of 4,300. So if you think about that, 25% of our portfolio is going to have new stores, new Zara's, new Vioris, new Aloes, new Dick's House of Sport. And customers are definitely coming back in. And, what we focus on is making sure there's a great experience when a shopper comes to our center. So it's all about product. Retailer has to have great service, inventory. Inventory is critical.
How do you sort of determine, when trying to create these longer term partnerships? In the old days, you've got that gigantic department store to kind of anchor, but now you're talking about a lot of stores that are a little bit more niche in that regard here. So how do you determine, that you've sort of hitched yourself to a winning horse, so to speak?
The omni-channel strategy of most of the better retailers, they want to be in the Class A, the high trafficked centers. So, they're not trying to blanket a trade area or blanket a market. They want to be in the best center because they know that enhances their sales, website, and just overall brand and profitability. So whether it's apparel, food, anchors, we basically try to come up with a merchandising plan to add value. So we love Din Tai Fung. We love Addicted for the Gen Z. We love Viore. We love Apple. We love everything. There's many. I don't want to offend some of our other customers, but we're really trying to understand what the trade area wants and what we need to draw in. We had over 270 visitors to our portfolio last year, just to give you some sense. And the average customers that come in are anywhere from 8 million to 15 million customers at each of our better centers.
Wow.
Well, I know you don't want to offend anyone, so I'll ask this next question delicately. But, that turnover that you're seeing, you mentioned Avur, you mentioned an Aloe, my ears perk up. I have to imagine, though, that they're taking space from someone else. So what kind of brands, what kind of stores are you maybe sort of gravitating away from?
Well, the whole regional mall business sort of almost came under itself, with the department store closure, the Amazon effect, global financial crisis, COVID. So right now, for these centers that are almost 1.5 million to 2 million square feet, we've largely tried to basically block and tackle refilling anchors. Once the anchors are refilled, then you go into the inline. There were many tenants, without naming names, that were kept on temporary tenant basis, short-term, low rent, basically not as productive. As we put 30 new anchors into our portfolio, we found demand to come from the newer generation of retailers. And that also, like older generation, like we talked about Coach, not that they're older, but they've reinvented themselves. Gap, Abercrombie and Fitch, they're just going through, trying to approach that Gen Z customer, which I'm sure we'll talk about in a minute.
Well, I do want to talk a little bit about your physical footprint first, because you own about 36 malls, but you have been offloading some of your property in the last year and a half or so. I know that you're currently under contract to offload a mall in coastal Santa Barbara as well. So, I mean, when you think about the map of the country, what areas are you emphasizing versus might you pull back from a little bit here?
So when I joined 2 years ago, I realized that we had to put a lot of capital into our existing portfolio. And so over $2 billion is going into our current portfolio. Couldn't spread that out across the entire number of assets. So we made a decision to, as part of our plan, to sell $2 billion of our existing real estate. We focused on trade area. We focused on competition within that, kind of the regulatory framework in those marketplaces. So we could get convinced that if we're going to put that capital into those centers, those customers will come. In effect, I talk about it a lot at our company, transform and elevate. We're transforming these centers and elevating our tenancy.
I am curious, though, about the geographic mix, and obviously you have a big concentration on the coast here. But is there a difference between, say, a Tyson's Corner in Virginia, which is a little bit more of a high end, versus a mall in, say, Evansville, Indiana, or do you kind of take the same approach?
They're very different, and they're very different for the retailers. Going back to the omni-channel strategy. Retailers today want to be in high trafficked, high income, really robust trade areas. And so Tyson's is going to be that place, that marketplace. It's growing trade area. Evansville is not growing. I'd say it's more static, flat, in terms of growth. And so I think retailers are really prioritizing those fast growing major markets to expand. Once again, supporting their online sales strategy and brand.
All right, really interesting conversation. Really appreciate your time. That is Jack Hsieh. He is president and CEO over at Macerich. Just a fascinating conversation on the mall, which it's back, baby.
It's back. People hanging out at the mall.
Yeah,
it's like I'm a kid again.
My mom, I grew up in New Jersey. She would not let me go to the mall. Everyone else was hanging out there, but she was like, "You're going to be a mall rat, and I won't let it happen."
All right. Well, we got to bring back Orange Julius. That's probably before your time. But anyway, I spent a lot of time there. All right, our next guest, he's been actually tracking what's been going on with mortgage securities. He's actually seen a revival there in private label mortgages, and that bond market could grow to $2 trillion in the coming years. That would make it the single largest component of the structured credit market. That conversation coming up next with the CEO of Ellington, Michael Vranos. Actually, he's joining us right now. Excuse me, I didn't realize that we were taking a break. Mike, great to have you here on the program. I'm actually fascinated by this white paper that you put out here, because we talk about the evolution of the mortgage bond market, how we went from private label to Fannie and Freddie kind of dominating everything. And now you're seeing a lot more interest right now in these private label securities. Give me a sense as to why we're starting to see that uptick in the level of volume in that space.
Well, you've got this 2.0 non-agency mortgage market, and it serves borrowers who are self-employed, investors. There's a growing investor base for homes, those seeking jumbo loans, reverse mortgages, second lien mortgages, things like that. And you're right, it's standing at $600 billion right now, but last year alone, Over 220 billion of these loans were securitized. And this year, the number should exceed 300 billion. And I do think this market is headed for 2 trillion in total size in the coming years. And one important thing to note, sorry.
No, go ahead, please.
Yeah, I mean, these are not the loans of the pre-Great Financial Crisis, which were subprime and liar loans and things like that, no money down loans. The loans that are being, originated now are with very high credit quality borrowers and very low loan to values. Like the securitizations last year had an average FICO borrower of like 753 and a loan to value of below 70.
Yeah.
And you can see it in the data. You look and see the data. Over the last 5 years running, average losses in these deals have been about 3 basis points. It's practically zero.
Well, that's what I'm curious about, Mike, because, there are a lot of people going to try to draw comparisons between the growth of this the private label market now and what we saw back in the early 2000s and obviously in the 1990s, where, of course, you made a bucket of money off of that here. You're saying that the parallels aren't there.
Because of the quality of the borrower. This market has policed itself since the Great Financial Crisis, and deservedly so. It needed to, and investors won't really invest in high LTV loans or low FICO loans. And so therefore we have this market that's really a very, very low credit quality. It's a growing opportunity for private credit investors because the collateral is single family homes whose values are very easy to ascertain. House prices don't move that much and they sort of rise over time with inflation. And that's much different than loans to small and medium enterprise corporations, which are running into trouble right now.
And I'm curious, you think about how big this market could become. What is the profile of the investor that you see coming into this market? Is it institutional? Is it someone else? What does that look like?
So basically what happens is most of these loans get securitized. And the way that an investor can get into this market is if you're an insurance company, you're buying bonds from the securitization. But the real good risk reward right now is in the equity pieces. And those are what's left over post securitization. They tend to be rather tightly held, mostly by REITs and drawdown structures and things like that. So a good way for an investor to get exposure to that would be through a REIT like EFC, our REIT, or others. And you want to look for those that vertically integrate the investment process, meaning they own an originator and may possibly also have a correspondent channel where they collect loans, put them into a securitization, sell the securities to other institutions that I had mentioned, and then retain the equity pieces, which have very high risk-adjusted returns right now. And again, they're diversified away from corporate heavy risk portfolios.
All right, Mike, we have to leave it there. We got to get it back for a longer conversation here. Real fascinating here to actually see this market now bubbling back up, and a great paper really laying out the case for why it is. The CEO of Ellington there, Michael Vranos, talking a little bit about the return of the private label mortgage-backed securities market. When we come back, we're going to set you up for what to watch over the next 24 hours right here on Bloomberg.
I think over the years, we've seen decades of evidence where DEI and the principles that underpin diversity, equity, and inclusion lead to strong outcomes. I think the political discourse, obviously, in the last couple of years has caused there to be a questioning of the validity of the benefits that we've seen empirically from diversity.
Legendary investment banker Chris Williams speaking there. That's part of a conversation that we had with some of the most prominent black business leaders on the state of diversity, equity, and inclusion. We're going to air more of that discussion tomorrow right here on The Close, and a big feature rolling out today in Bloomberg Business Week, where you can hear from all of those leaders there on your screen. As we wrap up The Close here on this Monday afternoon, we do want to set you up for what to watch over the next 24 hours, things that could potentially move the markets. And we start off, Katie, with some economic data.
Yeah, absolutely. At 9:45, getting U.S. S&P Global Manufacturing PMI, and then you only have to wait 15 more minutes for at 10 a.m. You get Richmond Fed manufacturing data as well.
And I know you love Fed speak. We're going to hear from Fed Governor Michael Barr. He's scheduled to speak tomorrow on the economic outlook. I'm not sure how definitive he's going to be able to be on that outlook, given what's transpired over the last 3 to 4 weeks.
Yeah, absolutely. And just the past 24 hours, even. It's certainly murky out there. On the corporate front, we know that Anthropic is also due in court. It's going to be interesting to see what transpires. And also, the Hill and Valley Forum is being held in Washington, Romaine. Tech executives and investors all gathering.
Yeah, absolutely. Maybe we'll hear a little bit more from some of those names. You heard from one earlier today. When we want you to stick around, though. Balance of Power is coming up next.